do what I always do, which is summarize what we've covered and where we're going today and material. And just to refresh your memory, Chapter 1 is the overview of just general tax history, levels of authority, and I interjected some tax policy issues that everyone should consider from time to time. I'll raise, which you've heard me raise before. I'm working, just so you know, and if and when it ever comes out, I'm working on a new op-ed, the title of which is Tax Robots, ? Ask Alexa. All right? So I'm working on this and see what you guys think. By the way, what do you think when you ask Alexa if Alexa should be taxed? And I'll leave you with that question. Okay, so I'll keep the edge of your seat. So if you get home tonight and you have Alexa there. Andrew?
I have an answer for it right now. Sometimes when she doesn't connect to Wi-Fi, I don't feel like I have an accretion of wealth. So I think I should be taxed on it.
Well, when you have connection to Wi-Fi, I'll ask Alexa if she thinks she should be taxed, okay? Don't worry, she doesn't say, like some questions people might ask her, she will say, you're being rude. In any event, so tax policy, a lot of fun issues out there. Chapter 2, again with concepts of gross income, and with respect to gross income, the breadth of income, Code Section 61, right? And accretions to wealth are generally subject to tax. But even in Chapter 2, we learn that not all accretions to wealth are subject to tax. That we have the independent life insurance company with the suggestion that imputed income is not subject to tax. All right? Imputed income is not subject to tax. But then we explore more about exemptions from tax beginning in Chapter 3. What's exempt from tax. And we learn that gifts and bequests are exempt from tax. And those are found in Code Section 102. But we find and we've seen this before, we'll see it again, that the code has a general rule. For example, 102A and 102C says that gifts made to employees don't qualify for the exemption. So we have the rule, we have an exception, we have an exception to the exception in the form of that proposed regulation. We also get the Waldorf case with the proposition that sometimes self-serving labels don't count. So in Waldorf, you remember, someone tried to label a bequest, but it was really compensation for services rendered. And it did not qualify for the exception. So that was Chapter 3. And we saw how it operated. And then we took a look at Chapter 4, and we got a taste of some other exceptions. In this case, dealing with employee fringe benefits in the form of Code Section 132. You remember 132A lists a series of fringe benefits under 132A, 1, 2, 3, 4, a whole list. And then the code sections that follow enumerate the scope of those exceptions. So we saw how those operate. So 130, and there's a whole series of rules. Remember, the exam's open book. You should write out some of these things so you can summarize in an organized fashion how these code sections operate. Because aside from the exemptions in themselves, there's reciprocal agreements, there's who qualifies as an employee, discrimination rules, a whole litany of special rules. And then we talked about Code Section 119, convenience to the employer. And we saw when it might or might not qualify for Code Section 119 exemption. And then we skip chapter 5, dealing with awards, because that's pretty self-evident, right? That if you win an award, it represents an accretion to wealth, generally taxable, somewhat akin to treasure trove, right? Somewhat akin, and we know treasure trove, right? The receipt of treasure trove is immediately subject to tax. It's not subject to tax, excuse me, let me reframe that. It's not that it is subject to tax on the sale or disposition, it is immediately subject to tax, right? Everyone agree? And when you find treasure trove, it is immediately subject to tax. It is not, there's no mechanism that says, well, the taxpayer doesn't, or lacks liquidity, we won't tax that person until they subsequently sell. That's not what the code says. And then, again, we skip chapter 5, and we took a path of discovery down chapter 6 last class. And chapter 6, when you hear, going forward, the word sale or exchange, you think, Jonah, what code section? Jonah? That's right. So, in this case, David, what code section do you think of? What code section? Sale or exchange, Matt? Can you repeat the question? When you hear the word sale or exchange, what code section do you think of? Matt, David? 1001. 1001? 1001. And Andy, what does 1001 generally say? Andy? Dick, you have an answer?
Amount realized minus amount.
So we got 2 next week, yeah, okay. I'll take you, whichever Nick grabs the ball, go for it.
Amount realized minus adjusted basis is your gain.
Gain or loss, right? Everyone agree? Amount realized less adjusted basis equals your gain or loss. Very simple formula, right? Amount realized less adjusted basis equals gain loss. Right? So, all right, gain or loss. Now, just to remind ourselves with respect to 1001, amount realized less adjusted basis equals gain or loss. And then, Andrew, so I think we have up to 3 Andrews, but Andrew, for you, with respect to gains, what do you need to show up on the tax returns? For gains, to show up on the tax return, what do you need? 2 conditions.
Sorry, I lost. I'm sure I know the answer.
I'm sure you do too. Bahara had her hand up first.
For it to be realized and recognized.
Realize and recognize, right, Andrew?
Yes.
And then, Simone, are all realized gains recognized?
Yes.
Is that true, Kathy? I'm saying, say again?
What was the?
Are all realized gains recognized?
Yeah. No.
And if the answer is no, why not? Anna?
I think it's, they are realized and recognized.
Well, I'm asking you, are all realized gains recognized, Miles? Always. Michael?
No. The code creates, for policy reasons, there are certain things that may be realized but not recognized. An
Okay.
example would be interest on municipal bonds.
That's not true, because interest is not, municipal bonds, code section 103, and there's no sale or exchange, right? So Perla, do you have in mind an exchange that might go unrecognized? Mike?
1041.
1041, right? The sale between spouses. So not all realized gains are recognized. And there's also so-called 1031 exchanges, right? And for losses, Amanda, what do you need?
You need it to be realized? One witness.
That's it? One condition?
Recognized also?
And that's it, Amanda? Two conditions? Trevor, anything else to add to the mix? The recipe?
Has to be allowed.
Right, Amanda? That's very important for your notes. Everyone agree? 3 fingers.
Yes.
Realize, recognize, and allow. Because the code has many, as we learned, disallowance provisions, right? The code creates a lot more hurdles with respect to allowable losses. I introduced just a smattering of limitations last class in the form of Code Section 165, which allows losses, but there's limitations there. Sales between related parties, Code Section 267. But I said that the code has a litany of other code sections, at-risk rules in Code Section 465, passive activity loss limitation rules 469, and there's even a new code section that limits the amount of taxpayers' losses up to a certain cap, Code Section 461L that in the new Tax Act. So my point is, gains, Congress in general opens the ability to have. Losses, Congress is going to be a lot more circumspect. Agreed? Congress is going to be a lot more careful. Okay, so what the authors do in Chapter 6 is they first look at the issue of adjusted basis, and then they turn their attention to amount realized. So adjusted basis is, as I think I expressed last class, is a topic near and dear to my heart, something that's very important for the tax system, and I spent a lot of time writing about. So you got to know your adjusted basis. You got to know what those terms are, and just to make sure that everyone's on the same page with respect to adjusted basis. Let me just ask folks, Dave, if you buy something, what's your basis in that property? Yeah, what's your authority?
1011.
Is it 1011 or something else? Alvin? Your name? What code section? Name you're going to say again?
1012.
1012, right? Because 1012 is cost basis, code section 1011, right? Code section 1011 deals with adjustment basis. And Ben, where would you find your adjustments to basis? Do you recall, Ben?
No.
Chappelle? That's right, Mike?
1016.
1016, such as common adjustments include? Mike, common adjustments to basis include?
Improvements.
Right, cause increase in tax basis, right? And decreases?
Depreciation.
Depreciation, right? Two common adjustments, upward and downward. So section 1016. You get an adjusted basis under code section 1011. And Valerie, if I give you an asset, I gift you an asset. Do you have income, Valerie? If I gift you an asset, I gift you Apple stock for the basis of 100,000 and it's worth 300,000. Do you have income when I give you that gift? Do you agree? Angie?
No, you
Why not?
have to sell it in order to have the income realized.
Why do you say it's not subject to tax?
It's not subject to tax until it's.
What's your authority for that it's not taxed? Jacqueline? Is that right, Jacqueline? For the proposition that you just received the gift. That's Brian, it's not subject to tax. Right?
Yeah, it's not subject to tax.
We all agree. What's your authority? Yeah?
Section 1015.
Is that right, David?
Yeah.
You sure? Definitely. Leo, you agree?
Yes, I do. 10:15.
For the proposition it's not subject to tax? Remember, clients do not come with code sections on their forehead. And we just talked, right, about the receipt of a gift. Francis, you receive a gift, subject to tax? What's your authority? Ron?
102A?
102. 1015, right, is just for the basis, right? So don't make that mistake, guys. People like me and people like, there's a lot of people, other people, you write an opinion letter and say it's not subject to tax and say 1015, and there's competition out there. I want to say, well, you really shouldn't hire this person because they're setting to the wrong code sections. I can unnerve your clients, and you might try to unnerve my clients if I cite to the wrong code sections, right? So code section 1015 doesn't cut it, right? So 1015, right, Joe, says what?
It's used the basis for gifts and transfers.
Let's say it loudly because we're a big room.
1015 is the basis of property acquired by gifts and transfers in trust.
And just train on the client, what does that mean? Just tell me, you said a factoid. But what does it mean in a practical sense? You're I always say to people, when you're explaining things, you gotta explain it to your supervisors and those who know tax, and then you gotta explain it to clients, right? There's a skill in both. Mike?
Typically, when you get a gift, the person who gave you the gift, you have their basis. Now, there are exceptions to that. So if you sell what you received at a
All right, let's start with just the general rule. I would agree, the general rule, right, Joe, is that you get a so-called carryover basis, right? So whatever the person had, if they bought it for 100,000, it's now worth 300,000, they gift it. What's your basis, Rudy, in that?
100,000?
100,000, right? I would agree?
Yeah.
Carryover basis. And what we'll see, I'll give you a little foreshadowing here. Bashad, what's your holding period in that Apple stock that I bought 5 years ago? I give it to you today, okay? And you sell it a week later. What's your holding period in that stock? How long are you deemed to hold it? Long-term or short-term?
Short-term.
And Frank, would you agree?
Yep.
And Trevor? Okay. Anyone have an opinion, Andrew?
No, it's considered long-term.
What's your authority?
Hold on. 1221.
That talks about a capital asset. What is a capital asset? Not 1221. 1223, code section 1223-2. 1223, open parentheses, the number 2, close parentheses. Okay, 1223-2. Says that if the recipient takes over your tax basis, the recipient will have your holding period. All right? So 1223.2 for the proposition that your holding period now, the shot would be long term. Right, the general rule, again, with respect to basis, is that when you get a gift, it's a carryover basis. Now, let me just go to the very top and ask Andrew at the very top. Is that rule always true?
If you gotta get, so carryover basis situation?
Yeah.
It's not always true, but I can elaborate on that.
Matt, can you?
Yeah, the fair market value is lower than the original cost basis. That would be the new cost basis.
So say the rule.
It's code 1015.
Yeah, but explain the rule and use an example.
Okay, so if the fair market value should be used as the cost basis if it is lower than the purchase price, the original cost basis.
Well, you don't see anywhere in the code the word purchase price. So let me just ask Nick, do you have a clarification on that? Mike, you're going to chime in?
So if the fair market value of the gift is lower than the adjusted basis at the time of gift, then it depends on when you sell.
Not when, but at what price.
What price you sell.
So if you buy something, picture if you will, you buy the Apple stock for $100,000 and you gift it at a time when it's worth $30,000. Everyone have the fact pattern? Buy it at 100, sell it at 30, excuse me, gift it when it's 30. Okay, so in fact, if I'm making a gift to Dan here, it's as if I'm, in theory, if the general rule of 1015 applied, I would be gifting him a $70,000 loss, right? Everyone agree?
Yeah.
If he was allowed to use my basis of 100, and it was worth 30,000. That's not a good, from a policy perspective, it's not a good idea to allow people to gift people potential losses, right? Because games could be played, right? Apparently, I like Dan, or else I wouldn't have been making a gift, right? In the very nature of a gift. So there's potential for collusion between us, right? He's in a higher tax bracket than I am, right? I could use him as a proxy to take the loss, and then maybe you trade up and make a gift back to me. So 1015A grafted into it is an exception that in that circumstance, if Dan subsequently sells the property for a loss, say for $25,000, that he could command only a $5,000 loss, right? If he subsequently sells it for gain and sells it for, say, $105,000, then he can use my basis of $100,000, and he would only have to report a $5,000 gain. If he sells it anywhere between $30,000 and $100,000, pursuant to the regulation 1015-1A2, no gain or loss, right? You remember that regulation?
Can you just go over the piece where you said if they sell it at a loss?
If he sells it at a loss, meaning he sells it for $25,000, right? I bought it for $100, gifted to him when it's worth $30. Then I sell it to him. He sells it, excuse me, at $25,000. He can only get a $5,000 loss. All right. Now, insofar as basis is concerned, if I unfortunately die and I bequeath it, okay, so we're looking at bequest. Elizabeth, what rule applies? If I bequeath it, what's your basis in the property? What's your authority? Nick, you said?
1014.
1014, and Andrew. Is that rule always true, Andrew?
Yes.
Sure. EK, is that rule always true?
Yes,
You think so? Lower to you, Nick?
Isn't that 1041?
I'm dead, not married. Right? And no necrophilia. Leo? Francis? Sure. Mike? Ben?
1014E,
Which says what?
you're trying to work the system.
And I'm dead, so how am I working the system?
You're about to die, and I gift all my shares to you. Then you die, and I get those shares back.
Okay, what happens?
That would be me trying to work the system and probably be null.
Right, you do not get a basis equal to fair market value. Understand the game Ben is trying to play? He's trying to stuff me with property, appreciated property, hoping I'll bequeath it back to him and ultimately at a higher tax basis, right? Be forewarned, that game is being played. I know several people who have been playing it, keeping their fingers crossed that the person they're gifting to does not die within 1 year. But after that, all bets are off. All right? All right, just so you know, a little foreshadowing here. Angel, what do you think the holding period is in that circumstance? I died, bequeath your property, Angel. I died, the property's worth $100,000. You get the property, and 2 weeks later, you sell it for $103,000. Obviously, under code section 1001, you have a $3,000 gain, right? Long-term or short-term, Angel? You're whispering.
Short term?
Okay, so you would think, right? Everyone agreed. You would think. Is that the right answer, though? All right, yeah. Have a response? Is that the right answer?
No, it's not.
What is it?
It's a carryover basis.
We know the basis is not carryover. We know it's fair market value.
It's
I'm asking the holding period.
holding period that the person home before.
Is it? Where would you look? What code section, guys? For an answer. 1223, now Francis is saying 1223-2, but in that circumstance, Francis, it doesn't apply because that, the person, the recipient angel would have to have my basis, and he's getting a new basis, right? So 1223-2 doesn't apply, but 1223 is a good place to look. Where else would you look, Francis? Keep scanning the 1223. Anyone else? Anyone else have an answer? Joe? Right? Michelle? 1223.9, it says what?
In the case of the person acquiring property from a descendant or to whom property passed from a descendant within the meaning of section 1014B, and then with 9B, so such property is sold or otherwise disposed of by such person within 1 year after the descendant's death.
Yeah, it's automatically long-term. So, I bequeath this property to Angel, a day later he sells it. No matter when he sells it, he's gonna get long-term capital gain treatment.
What's the authority?
1223.9. All right? So as you're going through chapter 6, as we did, we talked about how to compute basis in all these different circumstances. And then the authors, the second half of chapter 6, deal with the concept of amount realized, right? what is the amount realized? And in the case of amount realized, Kim, what does it include? What does the word amount realized include?
The amount of the property.
Just say it loudly. Because
The amount of the property.
what does the amount of property mean?
The amount you bought it for. If you paid for it for like.
But remember, the amount realized is what you're receiving, not what you paid for.
Oh, no, yeah, I don't think you realize, that's more realize. Realize is the difference of how much you sell it for and how much you pay for it.
Would you agree, Valerie? Is that the amount realized?
Realize is-
Where do you look?
1,000.
Valerie? Where do you look for the amount realized? Where is it defined? Okay?
1001A.
Is that 1001A define it?
1001B.
1001B. And Angie, what does it say?
So that's the selling price is the amount realized minus basis, and we would have.
Fine. The amount realized, do you see the word selling price in the code? Don't look too hard, you're not going to see it. Okay? Vikram, what do you do?
In the,
What is the amount realized?
the sum of money plus the fair market value.
Okay, so it's the sum of money plus the fair market value of what you receive, right?
Receipt, yeah.
Francis, you had your hand up. Is that the only thing?
Yes.
You're whispering.
Yes, money received plus the fair market value of the property received.
Yeah, but did you write something in your margins, Francis? When we talked last class about possibly writing something in the margins that you should never forget, did you do that, Chakal?
Liabilities.
Liabilities! Didn't everyone do that last class? Because you don't want to forget that, because it's not going to be a pretty day, your midterm, final, when you graduate. And if you forget, when someone asks you who you have for tax, just remember, you don't remember, okay? If you forget to include liabilities in the amount realized, just forget my name, lose that number. But if you remember, here I am. I won't take any credit, it's all you, not me. But you have to remember, right? And these codes, let's face it guys, they don't have much resale value. And they're probably worth more if you have really good notes in the margins, right? People will pay a premium of your brilliance. So, I would think next to 1001B, maybe in bright red, blood, whatever it takes, you will write liabilities, right? You will not forget liabilities. Not only and our authority for liabilities, even though it's not in the code itself, John, how do you know it includes liabilities? John? It's not because I say so. Why do we include liabilities, John? John, go. John, you're silent.
Who, me?
I'm not saying Ron, I'm saying John.
Oh, sorry.
That's me?
Yeah. John, is that how you pronounce your name?
Yeah, I didn't know if you were, I thought you were looking at him.
No. How do we know it includes liabilities? Sorry? Just say it loudly.
Revenue and expense?
Excuse me?
Oh, no, I'm thinking about something else, never mind.
How do we know it includes liabilities? Right? Yeah, we would say Crane, right? That's one. Crane or the Tufts decision. Matt, did you have another authority?
Regulation 1001-2.
Yeah, 1001-2. Right, Matt says to include liabilities as part of the amount realized. Which makes sense. If someone is taking, don't you feel richer, right? If someone's taking property subject to your liability? right? So no one's going to forget that on the exam, whether it be a midterm, final, when you're in your practice, you're not going to forget that, right? So, chapter 6 looks at amount realized the second half.
Would an example of that 1001B, because I was out last week too, would that be more like if you buy a home and the person has those old taxes, maybe had a lien against them or something like that?
Well, if you buy a house and you take the property subject to that liability, you buy it, part of that amount realized includes whatever liability you're assuming on their behalf. And somewhere, this gentleman can tell us, the last class was taped just like tonight. And I strongly recommend during the break, whoever couldn't make class last time, to talk to the gentleman and just make sure you can find out where you can find the last class. Or if you're vegging out on me tonight, you may want to watch tonight again. It sounds painful. If you're already here, you might as well be in the moment. All right, so everyone can do chapter 6. We left off, I believe, on page 154. Before I continue, here's what our goal line is. We're going to finish chapter 6. We are going to then, once we finish chapter 6, we will be able to numerically compute all gains and losses. We'll then move on to chapter 21, and we'll try to figure out what is the character of the gain and loss, all right? So part of our objective tonight is, again, once we figure out how much, we got to figure out what is the character of the gain or loss. Before I go on, any questions on the material? No substantive questions? All right. Now then I get to pause for a moment and say, did anyone do anything interesting this weekend? I found out that some people, not myself, went to the Ed Sheeran concert. Did anyone go to the Ed Sheeran concert in the class? There are no Ed Sheeran fans, apparently. Anyone else see anything else or do anything else? Rumor mill has it the movie The Wife was supposedly very good. No takers on that one either? No one did anything exciting this weekend?
What's our Yankee game?
Went to a Yankee game? Okay. Big room.
I have a pool tournament.
What does a pool tournament mean? Like shooting pool?
Yeah, like billiards.
Okay, how'd you do?
I did pretty well. I mean, like we won like the first match, and then we had another match at 9:30, but we lost that.
Okay.
And so we have another chance like December.
Just remember, Big Rum, if you win, taxable. Right? Just changing your whole motif, right?
Yeah.
That's 6 to 1.
That 25 grand is taxable. No.
Okay. And would you split that, or is that
It's split, so there's 8 members on our team, so we each get 5 grand apiece.
Okay. Last I checked, real money. All right. Anyone else? Nothing else? Kim, you were going to do or say?
I traded in my car, man. Got rid of it.
All right. Trade it up or trade it down?
Okay. I mean, I'm not into it like that, but I guess it'll be up. It's a new model. It's a new car.
All right. That's a good thing generally. All right. Congratulations. Anything else, or we're ready to move on? All right, so I believe we left off with question 3, right? And just to remind people, question 1 on page 154, make sure you can handle each one of those questions, because those are the kind of exam questions I would think are a fair game on my part to ask, right? Ready? Question 3. Gainer acquired an apartment in a condominium complex by intervitals death from relatives, okay? And we got the visual. Gainer acquired by gift. from relative. And let me just put some names here. So we're going to have relative is Jacqueline. She's going to give a gift to Angie, right? So we're going to do a little role play. So Jacqueline gave a condo to Angie. Both used it only as a residence. By the way, when Angie receives this gift, Leo, does she have income?
Yes.
Yeah, what's your authority?
Code section 102.
For the proposition she has income? Annie, would you agree? Annie? Annie, I don't hear you. Not sure. Let me just get Sahar. Kathy? Come on, guys. Simone?
Based on that subject to class.
What's your authority? So say it loudly. 102. That's not the question the authors are asking, but I'm saying, as you're reading the problem, right, code sections are floating in your head, right? Because when you meet with clients, they're going to speak in conundrums. Your brain should go to all different areas, right? It had been purchased by relative, that's Jacqueline, for $200,000 cash, and was given to Angie when it was worth $300. Okay, picture below. Again, Jacqueline bought it when it was worth $200, gave it to Angie when it was worth $300, right? And relative paid $60,000 tax on the transfer. So there's a gift tax. I'm just going to point out. I would give you this number. This is not a number you have to compute. There's a code section that deals with, there's a whole chapter of the Internal Revenue Code, chapter 12, that deals with gift tax. It's chapter 11 of the code, beginning in code section 2501. That's not our issue. In other words, that's a whole separate tax. And gainer or lender sells the apartment to shelter. And the question is, what gain or loss? Okay, so we're going to have, in this case, gainer, which is Angie's going to sell it to Valerie for $320,000. Okay, so we have three people. Jacqueline who bought it, Angie who got the gift, and she's going to sell it to Valerie. Everyone's got the visual down here? So what gain or loss to gainer on her sale? That's, in other words, what's Angie's gain or loss on her sale to Valerie? Okay? And then it's going to ask, what is Valerie's basis in the apartment? Everyone have this? All right? Let me just mix it up here, okay? So, upper tier Nick. You want to tell us any gain or loss? Well, what code section comes to mind when you hear gain or loss?
Code section 1001.
Right, code section 1001, right? Everybody agree? Code section 1001. And when you hear code 1001, we know our formula, right? So the question becomes, one of the questions, what is the amount realized, right? Everyone agree? What is the amount realized? In this circumstance, guys, we know code section 1001B comes into being, right? So what is the amount realized? Perla, let me just ask. Perla?
I'm kind of lost.
You're kind of lost? I'm trying to compute gain or loss, right? And we have Angie who's selling her property to Valerie. Joan, what's the amount realized? Yes.
20,000.
How much?
20.
Where'd you get 20,000? Rudy, how much is the amount realized?
Is it 320,000?
Isn't it 320,000, guys?
Yeah.
Is that the amount of cash received? All right, so you got one half of the equation, which is the amount realized. The second half of the equation is figuring out the adjusted basis, right? What is the adjusted basis here? Mike, you say it's what?
260,
How much?
260,000.
You say 260. Anyone have a different answer? Everyone has the same answer? Say again, Bruce?
I was thinking of
Oh, say again, Chabelle?
I was thinking of 200.
You say 200? Okay. 200, Rudy? 300,000? That? Okay.
You asking for the adjusted basis?
Say again, Drew?
Then you're asking for the adjusted basis.
Yeah, I mean, in other words, we know the amount realized is 320, right? That's the easy part. We need to know the adjusted basis, right?
So it would be 220.
And how'd you get 220?
Because of the formula, you got to take the,
Normally, it's a carryover basis. Everyone agree?
Yes.
yeah. You take
So,
the-
Andrew, just tell us how'd you get 220?
you take the gain of 100,000.
Where you're looking for this authority? Everyone wants to know why you're making an adjustment, because most people would just say it's 200,000.
I'm bad with authority.
Can't be bad with authority, Andrew.
Better with concepts.
Because in all seriousness, whether you survive in the tax world will be dependent on how well you can cite to authority. You can't just have the right answer. It's not going to be compelling to your clients, right?
10, 16.
And 16?
No.
No? So, Ron, do you have authority?
I think the basis is 260.
What's your authority?
1015D says you
D1.
add. It says you add the tax to the basis.
Okay. Ron says you would take 200 plus 60. His authority, he looks at code section 1015 D1, if you want to open up to it. And he checks his watch, and he notices it's after September 2nd, 1958, right? Good. And he says the basis shall be the basis determined under subsection A, increased by the amount of gift tax paid. So far, so good, right? But, Mike, you were going to say? Anyone going to disagree? Amanda, you good with that?
It looks like some adjustment has to be made based on 1015 D2.
Truth? You kept reading down at 1015 D6. Everyone take a look. Because we check our watches, and it's after 1976. So everyone, check your watches. It's after 1976. Don't say it out loud. Come up with a formula. Read D6 and see what number you come up with. I promise you, it's applicable. I'm not just making you go through a rat race here. Solid group, Cory, Rudy, you have a fraction here that you would apply? Vishal,
I'm still reading.
Cory? John, you had your hand up?
It would be 50%.
How'd you get that?
300,000 is a 50% increase from 200,000.
What number?
From 200 to 300 is a 50% increase.
You know what the fraction says? It says, in the case made after 1976, the increase of basis with respect to gift tax paid under under Chapter 12 shall be an amount which bears the same ratio of the amount of tax so paid, which is 60,000, right? Simone, you were going to say?
I was gonna give you my calculation.
Tell me what it is.
Right, but, I got 100,000, which was the difference in 200 and 300,000.
Okay, so that's the numerator.
So I got 200,000, which was the amount of gift.
How much was the amount of the gift at the time the gift was made? Wasn't the gift made, it was 300,000? So isn't it the denominator 300,000? So isn't it times 100 over 300? So the basis here would be 220, right? So the gain here would be 100,000. Right? Any questions? Everyone getting too fast?
Did you go over it again, please?
Well, it says take the carryover basis plus D6 says take the gift tax paid times the numerator is the appreciation of the gift. When Jacqueline gave it to Angie, she had bought it for 200, it was worth 300. So that means the appreciation was 100, right? And the value of the gift was 300. So 60 times 1/3 is 20. 200 plus 20 is 220. Game over. Questions? Everyone else got it, right?
Is this a similar example in treasury regs?
There's no
That's
very similar.
something-
No,
I mean, well, you know, I have some sort of calculation I haven't noticed. It's something.
Just make sure if you're looking at the treasury regulations, what year it pertains to, because these rules have changed, as you can see. It used to be more generous, where the taxpayer, right, could increase it by the entire 60 under 1015D1. Congress curtailed that and said you can only increase it by the gift tax relating to the appreciated value of the property, essentially. All right, if you think you know what you're doing, let's see if you can handle questions. Final question is, Valerie, since you bought the property from Angie, what's your basis in the property? You're whispering. What's your basis in the property? Is it 220, David? Dan?
I think it's 320.
What's your authority? Brian, would that be right?
Yeah, I agree.
What's your authority? Okay? 1012, right? That's what Valerie paid for it, 320, excuse me, she paid 320. And as a result, that's her cost basis under Code Section 1012. All right? All right, question C. Same question, assuming relative acquired the property for $80,000 in cash. Okay, that's Jacqueline. Picture sheet, if you will. Jacqueline gets the property for $80,000 in cash, but it's subject to a $120,000 mortgage, right? So Jacqueline puts down 80, buys the property subject to a $120,000 mortgage, on which neither she nor Gaynor was ever personally liable or ever paid any amount of principal. And then relative paid $30,000 of gift tax. So this time, Jacqueline, when she gives the gift to Angie, is going to not pay $60,000, but rather $30,000 of gift tax. Okay, upon purchase, Valerie's going to buy the property subject to the liability, and she's going to give Angie $200,000 of cash. Okay, everyone, take 1 minute and compute the gain or loss here. Thirty more seconds. I'll pick an aisle to go down and we'll ask for everyone's response. What's gain or loss that we came up with? Ready? Miles, gain or loss?
Wait, I'm literally doing the calculator thing right now.
All right. Hannah?
I'm sure.
Zahara?
I lost it.
Jackie? Simone? Joe? Rudy?
Give me like 2 minutes.
Corey?
I have two numbers, I'm not with one.
Give me a number.
I put 50,000
50,000.
and I wanna say 80, 50 and 80.
You want to say how much?
50,000 and 80,000.
You gotta pick one of the two. You never had the luxury. Jackie? Michelle?
Still working on it.
Frank?
Still working.
Robert?
I think it's a loss. But I don't know how much.
Anyone have 100% comfort that the miles who are going to come back to you?
I had, for the cost thing was 210.
So the cost is 210. You mean the basis?
Yeah.
Right? In this problem, we all agree the amount realized is 320, right? The question is, what is the basis, right? And do we agree the amount realized is 320? Because remember, Valerie's only paying $200,000 cash, right? So is the amount realized 200 or is the amount realized 320? Mike, Jeff?
320, you said also includes the mortgage.
Okay, it includes the liability. Everyone agree? So it's 320. Go ahead, Brady.
I'm a little bit confused. So he still sold it for 320.
By the way, she.
I'm sorry, she still sold it for 320,
Yes.
and that includes the $200 liability.
It's 120.
120.
Read the problem for me, it's 120 liability. That's why Angie's receiving 200,000 in cash, right?
Oh,
Okay? So the amount realized is 320. The question du jour is the basis. So what's our starting point? 200, right? Plus, how much gift tax was paid? Right? Now, you could argue, there's two different ways of looking at this, that, what's the numerator?
100,000.
And the denominator is, let's say, at the time, 300,000, and this would result in 210, and the gain here would be 110, right? Everyone agree? That's one possible answer, right? Let's consider a different answer. 200 plus 30, right? Now, if you remember, Jacqueline's giving this to Angie, right? And she bought it for originally 200,000, agreed? She bought it with 80,000 in cash, 120 liability, right, Jacqueline? That's what you bought it for, right? And Angie received this property, right? And we agreed that the numerator had in Jacqueline's hands gone up by 100,000, right? Everyone agree? No controversy. Now, Angie, let me ask you a question since you've been playing along with this the whole time, and you're the recipient of this. I want you to be emotional here for a moment, not with any tears or anything like that, but emotional and empathetic, meaning you're going to put yourself truly in the shoes of the taxpayer, and you receive the property from Jacqueline. And we have two different scenarios. Scenario one is where you receive the property, where she bought the property with cash, and scenario two, she bought it subject to the liability. Are you happier in scenario two, less happy, or indifferent? So everyone get it? Either Angie is going to be less happy, the same happiness, or even happier than she was in scenario one, right? Those are three options.
So definitely less happier.
Don't give her a reason yet. She's not a happy camper, she claims, okay? She's not a happy camper.
Comparing to.
Right, relatively speaking.
Comparing.
So Jen, is she right in her emotions?
Not sure.
That's right, Amanda. Is she off base? Amanda?
You're saying she's less happy, correct?
I'm not saying anything. She's saying she's less happy.
Yeah, because she's got the mortgage liability.
So what does that mean as a practical point of view?
So I'm responsible for the mortgage?
So she's responsible. So, Angie, now articulate why you're less happy.
Comparing to the first option, I got the gift. I received the gift. $200 cash, so there was no liability.
You didn't receive cash, you received a condo.
Yes, correct. But
And how much was the condo worth in scenario one?
which was 200.
It was worth 300,000, right?
Yeah.
That's a good day in her life, right? She got a nice new condominium worth 300,000, right? Everyone agree? That's a good day, right? You're happy.
Correct.
Scenario two, why are you less happy?
Because now the property is not worth that much since there's
It's still worth 300,000.
Because there's 120,000.
Ah, but there's a $120,000 debt, right?
Correct.
In the second scenario. Everyone agree? Yeah. So why Angie's happy, she's not as happy in the first scenario because this property is subject to a debt. So could you argue that, remember how the code, the phraseology of subsection 1015D6 says the denominator should be the amount of the gift. And Angie, if you were talking to me and I said, oh, you got a gift today here from Jacqueline. Can you tell me how much it's worth? Would you say it's worth 300 or do you say it's worth 180?
It's worth 180.
So you might say it's worth 180, And in that particular fact pattern, if you do say that, that's not a bad outcome because that means that you're going to get a higher tax basis, right? And it's going to yield a smaller gain. Everyone see what we've done? We've changed the denominator. And appropriately so.
So which one is right for the exam?
Don't you like the eloquence of the whole equation?
Don't confuse the confused.
I think there's a very good argument. There's no authority on this, proof positive, but the language of the statute, this has not been argued either way. But I think in the absence of case law or an administrative ruling, and this produces the better result, I would argue this is the right result. So Elizabeth, for your notes, and for exam purposes, use this. John?
You're allowed to give someone a liability?
Sure, if they take it subject to the liability. Right? When Valerie buys this property subject to liability, what's her basis in the property? Valerie, what's your basis in the property, or you're still catching up?
Yeah, I'm still lost, I'm
You're still lost. All right, Ben, what's her basis if Valerie buys this property?
12?
You can't just say 10, 12, give me a number.
Oh, well, you're looking for a reference.
Angie made a great, excuse me for saying this, great mistake. Ben, what's her basis?
The just basis would be,
Valerie's.
Valerie would be the 667,000?
That's the gain. That's the gain Angie
No,
has to report. I'm asking Valerie's basis to Val. 320, right? Right, Anna?
Yes.
Please, 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 when we have the exam in 3 weeks, don't make that mistake. I'm going to be your biggest proponent. I want everyone here to succeed because it actually makes me feel worthwhile to be here on Monday nights. So I need everyone here to excel, all right? Which generally means you got to put anywhere from 6 to 10 hours outside the classroom into doing work, all right? And don't let this slip away and then try to catch up at the last minute. It never works. So just make sure you're keeping pace, guys. Any questions? Mo?
In terms of this example, could you like use other people's like names? Are you saying that the basis for shelter is 320,000?
If Shelter bought it, Shelter has a $320,000 basis. Right? It's like Crane.
Just wanted to confirm.
All right, other questions? Andrew?
Yeah, I'm sorry, but I missed the section that was at the end. I would refer to.
I just cited the Crane decision for Shelter's basis in the property.
Thank you.
I'm still stuck on that 180. Is that 180? That 180.
That's how much wealthier Angie received when she receives a gift. She's receiving property worth $300, subject to $120,000 liability. So that's how the amount of the gift. All right, any questions before we move to chapter 21? All right, we're going to move to chapter 21. All right, capital gains and losses. Now, we should, by show of hands, just so we get our signal straight here, up front, express, and if you don't mind, don't, how do I frame this? Have an opinion. So this is binary. Either you agree or disagree. So how many, and I'll tell you the questions in advance and then ask you to raise your hands so you know what the two questions are. How many of you think that there should be in the Internal Revenue Code a capital gains rate preference, meaning, and let me pause for a moment, then I'll raise the questions. Currently, what is the tax rate for ordinary income, the highest tax rate? Say again? Is that the highest ordinary income tax rate? David, do you know? 37. What's your authority, David? Got to know the authority, right? Annie, do you know? Sloan? Kathy? Section 1. Right? Section 1. 1A, 1B, 1C. What is the highest capital gains rate? Or what is the general, when they're talking about capital gains, in general, what is the capital gains rate applicable to most people?
Well, I guess it depends on what item you're.
It depends, but in general.
So 28%?
No, that's not the general rule. Miles?
15%?
Is that the general? Joe, I would argue.
Isn't it 40?
Not 40, David. 20. Okay, generally, look, there are differences, and we'll go through them. Remember for the exam, I'm not going to ask a single, can you compute a taxpayer's tax liability? Your software, trust me, we'll be able to compute that, okay, guys? It's not going to have a problem there. I need you to do other things. That's going to be the job of your software. But in general, most capital gains are recognized by high income taxpayers. And I'll repeat that. Most capital gains are recognized by high income taxpayers. That's a factoid. That's not me being politically biased. That's just a reality, okay? And surprise, surprise, that those, I'll call it the 1%ers, own much of the capital in the United States. They're subject to the highest income tax rates. Again, this is not a political bias of any sort. And that being the case, they're subject to the highest income tax rate applicable to capital gains, which in general is 20%. Right, so we have two different rates, right? We have a 20% rate and a 37% rate. So the 20% rate is almost 1/2 of the 37% rate. Agreed?
Yeah.
Now I can frame my question, or you can respond at me. Show of hands, don't do it yet. Here's the two questions. How many of you agree that there should be a capital gain rate preference? And conversely, how many of you think that there should be no preference and that capital gains and ordinary income should be taxed at the same rate? Whatever the rate is. Let's not get into the rates tonight, but the question is, should capital gains be afforded a preference? And then if the converse will be, no, it shouldn't. So show of hands, raise them high if you think there should be a rate preference afforded capital gains. And you can't sit on the fence. So is that the highest you can raise your hands, those who, okay, and those who think there should be no rate preference? Okay, so can I say, at least this is my observation, that those who thought there should be a rate preference, I'm going to say it was about 65% of the class. Those who didn't was about 35%. Was that your take? Did I see things incorrectly through my glasses? I think I saw it correctly. So it's not, sometimes I sit in class and it's 90% who thinks there should be a rate preference and only 10%. You guys are a little bit more on the even. Now, there are some of you who are very, how do I say, energetically supported the rate preference. I saw your hands really shoot up and shoot up high. If you had two hands and you could raise your feet, you would have done it too. So, being most enthusiastic of you, can you express your, why would you say that there should be a rate preference? Because, and some of you feel apparently very strongly about this. Okay.
So you said that capital gains are only subject to the high income taxpayers, is that what you said earlier?
No, I said that high income tax payers generally bear capital gains, where if you're working at McDonald's, you don't have much capital invested, right? You're just trying to make ends meet, so you don't have much in the way of Apple stock, right?
If we say if you take out there was no preferential treatment on capital gains, isn't that kind of discrimination, because you're taking off high income taxpayers don't have to deal with capital gains anymore.
When I say, should it be subject to 37% rate instead of 20%? That was my question. Right?
It fuels investment. I think it gives an additional push for people to make additional investments into companies, into things of that nature, which generate, capital gains and losses. But I think it's
Right, so Mike's argument is the economic argument that we need this rate preference to spur investment, okay? Anyone have a counter to that, or are we gonna just let that one go? Anyone? Matt?
I think that proportionally it makes people with lower income, people who don't have capital, are paying a higher percentage of their income to tax. That's the other side of it, right? So if you're making a small amount of money, right, you're gonna be subject, well, the people who aren't, if you're paying through your tax, through income tax, you're paying more tax. So it seems like kind of like a tax loophole that people who can kind of hide their money.
I wouldn't call it hide. I mean, let's not go there,
The
but
money you
people.
invest in capital, you pay the higher rate, right? You earn capital, you pay a higher rate on it.
But Michael's point is it's after-tax money, Frank?
I mean, you could argue, it doesn't really spur investment, because you look at an IPO, which is the source of much funding for some of these companies. Majority, I would argue, is institutional investors. So your average taxpayer, even if they're wealthy, isn't jumping in on an IPO, because they're probably it's been oversold anyway. So only the rich people are getting that. So it's not really delivering capital to companies.
No, but those institutional investors, it's those wealthy people who invest their money into those institutional investors.
So you have to have like a high net worth income. Like Morgan Stanley only reaches out to people with like only 10 million or more that are high net worth.
Right. So think about that company with the IPO without those people investing in Morgan Stanley. Where are they going to get the money to start their business?
All right, I mean, we can have a healthy debate over coffee later. But the point is, Andrew, you're going to comment?
Yeah, I mean, just kind of conceptually, I mean, money that you invest is usually after-tax money. The tax or investment earnings at an ordinary rate that you already paid before investment.
But remember, you're not paying tax again on the same money, you're paying tax on the earnings of that money.
Right, so you're saying you should be taxed at a preferential rate. I'm saying, yes.
I'm not saying it should be.
I'm not saying you're saying it should be, I'm saying, yes.
All right, look, one argument is that it should spur economic growth. Now, I personally will say, and I think others in the class have expressed it, that investors, taxpayers, it's not entirely clear if you didn't have a preferential rate, people might invest in Google stock instead of putting money in the bank, because why not invest in Google? Because it's going to throw off more profits, and as a result of throwing, you're going to get a higher rate of return even if you have a higher tax burden. So I'm not so sure, personally, if it spurs economic growth, because there's only so many investments people can make. And yes, it would be a little bit less attractive, right? It would be less attractive if capital gains were subject to tax at ordinary income tax rates. But people have limited options. They could put in the bank, but because there's limited risk, there's limited reward. Or people can invest in real estate or stocks. And each time there's increasing risk, we know there's a potential for increasing returns. albeit it would be a bit mitigated if the tax rates were higher. What's another reason for having a preferential tax rate? Well, another reason, right, John, is?
Is it already tax one for the most part?
Well, it's already been taxed, but the growth on it has never been taxed. So I don't know if that really works as an argument, but some people would argue that there's income bunching, right? That when you have capital gains and you've owned Google stock for 10 years, and each year you bought it for 100, it appreciates over the next 9 years $100,000 per year, and now you're taxing it all in 1 year, you're going to be thrust into the higher bracket structure, right? So there's an argument that you're bunching the income. However, if you are, say, a litigator, and you're working on a claim, an antitrust claim, and it takes you 10 years of toil and sweat to win the case. You still collect all the income in 1 year, you're still going to be thrust in the higher bracket. So I don't know if I find that argument compelling that it's all being bunched in 1 year. There should be a preferential tax rate. Another argument is the so-called lock-in effect. That remember that if someone makes an investment and there's going to be growth, right? They buy something, say at $100,000, it appreciates to $1 million, and if there's a very high tax rate, even though it's a lousy investment, they may stay with the lousy investment because once they sell it, the after-tax proceeds may be so small that even if they found a better investment, when they measure yields, it may make sense to stay with the lower investment, the lower return. But again, I'm not so sure I find that argument compelling because there's someone else who will, it's not like that higher yield investment will go to waste because there's always going to be someone else in the economy who can make that investment. The point I'm going to make, and without getting into politics, is I stand not with the side, like, I'm just going to say, I'm one of those who say, I'm not so sure that there should be a rate preference for capital gains. And there's many people who have said the sky will fall if capital gains and ordinary income were taxed at the same rate. Bear in mind that a good, I don't think I'm exaggerating, 1/3 of the complexity of the code is engendered in having this rate difference, okay? Kid yourself not. There's a lot of complexity having this rate structure the way we have it. And then also bear in mind, in 1986, part of the 1986 Tax Reform Act, capital gains and ordinary income were taxed at the same tax rate. And last I checked, the world did not fall apart in 1986, and then it was changed in 1990, and we had a 4 or 5 year, very healthy, robust economy. And it's not like the stock market fell apart during those years because people said, oh, capital gains and ordinary income are taxed at the same rate, guess we can't invest in capital assets. So just, there's a proven history that it's not problematic. So I'm just going to share that with you, that I'm not so sure as we're going through all this if the capital gain rate preference is a good policy. Particularly, I'm a big fan of trying to keep the code as simple as possible, right? Because simple is probably even simple. It doesn't always work, right, Elizabeth?
Correct.
So, go ahead, Elizabeth.
From international tax, you also say that it brings outsider foreign investors into the country because they only have to pay that low tax when they're investing in.
Remember, foreign investors never have to pay tax on capital gains to begin with. Okay?
Property.
In real estate, they do,
Yeah.
because of Code Section 897. But that's an issue, different issue. All right, so let's not go there for everyone else. So I'm just going to make the observation as you read through this material. Always bear in the back of your mind, is it worth it? All right? All right, so the authors go through, beginning on chapter 21, capital gains, and they give a little segment of capital losses. Okay? Now, capital losses, can you take them at your discretion? Can you take capital losses whenever you please? Ron, Mike? Can you take capital losses whenever you please? And if you say no, why not?
You can only take losses to the extent that you have capital gains, and then you can use an additional 3,000.
What's your authority for that? Ron?
1211?
1211, right? Now, why put such restrictions, EK? Why put such restrictions on capital losses? Why not let taxpayers who have an economic loss just take it? Why did Congress put that limitation?
Because to avoid tax evasion.
You avoid what?
Tax evasion.
Tax evasion, but you're not articulating, that's just a conclusion. What kind of tax evasion? Why? What would be the game people would play? If you could take capital losses whenever you please. Is this Andrew?
If I'm not mistaken, if I read it properly, because then people would try to offset the revenues that they would have.
Well, look, the author's on page 687. Back as early as 1921, they knew what they were talking about. If you look in the indented language, okay, back then, page 687, this indented language, like 10 lines from the bottom, says the government can collect a 12% on gain, okay? So at the time, capital gains were taxed at 12.5%, and the regular tax burden was 58%. Is it take the example of someone who earned $350,000 per year. Assume that he bought 5,000 of shares, 5,000 shares at par, and he sells the shares in 1922 for 600,000, showing a profit of 100,000. So normally he would pay 12,500 as capital gains. But if he sells it at a loss of 100,000, and he uses that loss of 100,000 against his $350,000 of income, that would yield a $58,000 tax savings if you could deduct. In other words, if you have a rate preference, right? Capital gains, if you earn 100,000, it would save you, you would pay tax at $20,000. Agreed? And if you earned $1 million and you earned an extra $100,000, right, capital gains, on the capital gain portion you would pay $20,000. Conversely, if you earn $1 million and now you have a $100,000 capital loss, it would save you, right, $37,000. Everybody notice the difference? The losses when you're sheltering in again. So taxpayers would be strategic, right? We would instruct our clients, take capital gains in 1 year and take capital losses in the next year, right? Alternate years. Because in the years you have gains, get this great rate. In the year you have losses, you can use this as a tax shelter, right? And you can, the virtue of capital assets, right, investment assets, is unlike salary, which it's hard to time salary generally, right? Everybody agree? You can't look, towards the end of the year, you could tell your boss, pay me my bonus January 1st. But most places, you can't say, pay 90% of my salary next year, or pay me all today. Your boss is going to say, I'm not going to pay you all today, right? With capital assets, right, you can manipulate the timing. So Congress is fearful with respect to capital losses, and as a result, Code Section 1211, right, puts the brakes on taxpayers willy-nilly taking their capital gains, or excuse me, their capital losses. Agreed? Now, the authors, beginning on page 688, talk about Code Section 1222, which you may want to open up. Because you'll see, Code Section 1222 has a bunch of definitional provisions of what is a short-term capital gain, short-term capital loss, long-term capital gain, long-term capital loss, and it talks about the netting process. And you'll see what you need here in terms of meeting these definitions. Generally, you need a capital asset. It's got to be sold or sale or exchange. Okay? It's got to be a sale or exchange of a capital asset. And then generally to get to the promised land, it's got to be held for more than 1 year if you want long-term capital gain treatment. Now, again, in terms of complexity, again, I keep saying query whether or not it's worth it. There are different rates, some of you alluded to. You get it on page 691. There's a 28% rate. The italics on page 691. There's a 28% rate applicable to collectibles. There's a 25% rate imposed on unrecaptured 1250 gain. Page 692. There's generally two different rates applicable to capital gains, but I'm going to tell you again, for most of your clients, they're going to be at the 20% capital gains tax rate. On page 693, there's a computational section. But again, for exam purposes, I'm not going to ask, so you don't lose sleep when you look at the computations on page 693 and 694. They're interesting, take a look at them, but we're not going to go through and have you compute tax liability. Now, one thing I'll call to your attention on page 694. Notice with footnote 37, it says that there's a netting process. And we'll talk about that when we look at the problems on page 695 and 696. But if you look at the footnote associated with footnote 37, it says that generally it reaches a pro-taxpayer outcome. And there's no regulatory authority, there's no revenue ruling. Believe it or not, the best the authors can come up with for authority, and sometimes you take authority from wherever you can get it, it's the actual Schedule D of the Form 1040 produces the outcome that taxpayers wish, meaning it's a pro-taxpayer position. And I just call your attention that capital gains not only are given a rate preference, but there are many, many code sections that go beyond the rate preference, including if you look on page 695, there's a code section 1202 that with respect to certain qualifying corporations, if you own a certain qualified corporations, there's zero gain. And also keep in mind, and I mentioned this before, I think I did, Code Section 1014. Does the government generally lose or make money with the application of Code Section 1014? And you know what Code Section 1014 pertains to, right? Basis equal to fair market value rule, right? Government generally make or lose money on this rule? Lose, right? Because in many cases properties appreciate over time, and because of generous depreciation deductions, the basis is often less than the fair market value. So Code Section 1014, which primarily applies to capital assets, it applies to all assets, but primarily capital. Whose benefit does that inure to? Primarily the wealthy, right, who have capital assets. So my point is, again, with the rate preference, we already, again, whose favor does it really go in? Is it something that really, as the country as a whole, doesn't need it from a policy perspective? So what I'm going to propose, before we go through the problems here, is generally, as you guys know, my preference is to keep our breaks at approximately 9 to 10 minutes we can. Tonight, I've been told, but I hope I'm right, that, and I hope it's accessible, the people who are running it, I believe there is the dean's office has something on the second or third floor where there's free pizza and snacks. So why don't we take a 12 or 13 minute break, and hopefully you guys will find that there's food out there for everyone. If it's not on the second floor, it should be on the third floor, okay?
Oh, it's recording right now, so it's not gonna let me play the video.
Because I saw like the rest
Dude, I couldn't put it much. This whole side of the house walking down.
you don't want to hear from me. They're tough. The college, you have that. Just he's gonna, same concept, same way of the college. That's how it's gonna be.
Yeah, I just, there's.
No, I'm sorry, there are like three questions. Some are you gonna read? She said to start with the because you can run out of time. Which you did have to.
Are you doing this part-time?
Time on it.
Okay. Is your first answer?
Yes. Yeah, so we're just trying to like in contact
Okay.
No. You'll throw a question. What does this mean? By the time you get to it, by the time
And then I had,
we did throw one in the final, and I was down 30 seconds and I couldn't do it. But it helps you take notes of where it is, for you to go back and go later. So I was like, I was like, it says on the side, the code, because you can always go back.
Yeah, it was one response by 6 p.m. If I had sometime on Monday, it's like a it's so much worse than like. Yeah, we got there yet, but.
Yeah, so that, like, it's just, it actually takes, like, I would say like 6 hours. Yeah, so it's like, yeah, it's pretty long, because I thought it was gonna be like not small, but then I like managed to get it in 10 hours, so I was just
Okay.
but it was just a hassle.
Yeah. It's really not that complicated. It was like, you have like all these arbitrary laws that make no sense.
Yeah.
It's kind of confusing.
I have this, you know, like, I have, actually it's in my car, I'm like, shareholder myth. Do you have to read that one? Because I
I'm not sure. I had to rented the 2 books and she. There was
Is it this one or the other one?
and I got one Kindle.
Oh, okay. Because I have like this small one. Actually, like I found Are you insurance companies to submit to the NIC.
It's right here,
Yeah, it's so nice. I don't have
we get out, it's got to be. Oh,
Yeah, from Morris down here, it's 15 miles, but yeah, here it's 6.
Hey, are you the one who posts lectures online?
Yeah.
Where do you post them?
On YouTube. Just go Rutgers accounting app.
Would work out well.
Channel.
Lab? Okay.
No, web.
Web?
Yeah.
Web. Once I'm on there, how do I actually find videos?
Yeah, because I
can't find
searched.
Like from this class or from this class it hasn't uploaded yet.
None of them?
No.
Oh, okay.
Last week's class will be uploaded next week. And this class is gonna be uploaded after 2 weeks.
Okay.
It went fast, I just stood there.
Yeah.
Gotcha. No, I just thought I was. Thank you.
Because the only thing I found from this class is a corporate class.
What do you mean?
I didn't find this lecture on.
Yeah, last week's class is gonna be on there next week. None of the classes like from this semester is on there right now.
Oh, okay.
So it uploads every 2 weeks.
Alright.
So,
just search this on YouTube. It should be on there next week. The person yeah, it should be the last week's class should be up there next week.
yeah.
I didn't see my glasses.
Order them on Amazon, order units, order early edition, just kind of stuff. Guys, I think if I start talking, I hope, if I start talking that people will start coming, okay? So it's a little bit longer than my usual break, but I figure hopefully people are hobnobbing out there. But I want to make sure we get through some of the material. So let's just talk about capital gains and capital losses, and we talked about some of the policy underlying them. We talked about the tax rate differential. And let's look at problem 1, and let me just go through it for you. This begins on page 695. We have T, a single taxpayer, has a salary of $200,000 in the current year. He also has the following transactions, all involving the sale of capital assets. So we have a gain of $15,000 on a collectible and a gain of $20,000 on a stock. It says determine the amount of T's net capital gain. And T's net capital gain, in this case, keep it real simple, would be $35,000, right? We have two different kinds of capital gain, but the net capital gain is $35,000. And what tax rates would these be taxable at? Well, for our purposes, the collectible would be taxable at 28%, right? And the stock would be taxed at 20%. Do not worry about a question like problem 1C, because I'm not going to ask that kind of question about what would be the tax liability.
That was number A, you said it was 28.
No, I said A was 35, question B was 28% and 20%. Question C, I said don't worry about. Question two.
Quick question, why is the other one not 15 instead of 20?
Because I'm saying we're going to use the general rule of 20% for high income taxpayers. Question 2. Question 2, we have a single taxpayer as a high income taxpayer with a salary of $500,000 in the current year. Also, as has the following transactions involving the sale of capital assets. He gained $120,000 in stock held for 15 months, and a loss of $20,000 in stock held for 3 years. Again, I'm not getting into computing the tax, but in this case, you can net the gain and the loss, right? They're both held long-term. So in this particular case, there would be a $100,000 long-term capital gain, for our purposes, taxable at 20%. Question 3. Taxpayer who's in the highest federal tax bracket in the current year has a $5,000 gain from a collectible and a $5,000 gain from stock, both held long-term, right? And one is taxable, right, recall, at 28%, and one is taxable at 20%. And question 3A says, what is the taxpayer's net capital gain, and how is it taxed? The taxpayer also has a $5,000 loss held long-term. In this case, Code Section 1H demands that same category of income or same category of capital gains be netted first. So in that case, the capital gain would be netted, or I should say it the other way, the capital loss resulting from the collectible would be netted against the capital gain, the collectible capital gain. So if you net those two, what's left? A $5,000 gain taxable at 20%, right? So your answer to 3A is 20% capital gain. $5,000 taxable at 20%. Question 1B. What if the taxpayer instead has a $5,000 loss held in stock? In this case, there's another, again, netting process, and we would take the netting of the capital gain, stock capital loss, and that would mean there would be $5,000, right? Taxable at 28% in question 3B. In other words, again, you net against the same categories, right? You net against the same categories. Question 3C. What result is instead taxpayers' $5,000 losses from stock held short term rather than from the collectible? Okay? If the $5,000 loss is held from this short-term loss, in this case, again, it's a pro-taxpayer because now we have a loss that is not a long-term capital loss attributable to the stock, right? It's a short-term loss, and you can net that loss against the collectible. So the answer in 3C is that $5,000 loss can be netted against the collectible, and that would leave you with $5,000 taxable at 20%. And finally, question 3D. If the taxpayer has $5,000 gain from a collectible, and $5,000 unrecaptured 1250 gain, and $5,000 gain from stock, and a $10,000 loss from stock, all held long-term. Okay? So picture again, taxpayer's $5,000 gain from a collectible, $5,000 unrecaptured 1250 gain. By the way, that's taxable at 25%. There's a special rate that applies to what are called, and we're going to learn about these. It's called 1250 unrecaptured 1250 gain, and a $5,000 gain from stock, and a $10,000 loss from stock. Well, the $10,000 loss from the stock, that first has to be netted against the same category, right? So that's going to be netted against the $5,000 gain. So we're going to knock out the $5,000 gain from stock. What about the remaining $5,000 loss from stock? Should we net it against the collectible, which is taxable at 28%, or the unrecaptured 1250 gain, which is taxable at 25%? Which would produce the more taxpayer the more pro-taxpayer outcome here. Say again, Miles?
Collectible?
Against the collectible, and that's, you're allowed to do that. In other words, it produces a pro-taxpayer result, and you can do that. And therefore, last man standing is a $5,000 gain taxable at 25%, right? Because we can knock out the 28% gain utilizing the $5,000 remaining loss from the stock. The bottom line is, guys, again, the rules with respect to capital gains and capital losses, as demonstrated by this problem, is that you have to net the same category against the same category. But then you're at liberty to use the capital losses in a way that produces the most taxpayer-friendly outcome. Again, for exam purposes, I will not ask anyone to make actual computations. Okay? Capital losses. We talked about the fact that capital losses are limited by Code Section 1211, right? And there's different limitations that apply to corporations. There's different limitations that apply to individuals. And individuals can take 3,000 of losses. Corporations cannot take any capital losses up. You can only take capital losses to the amount of capital gains. Agree?
Yeah.
And the rules with respect to capital loss carry forwards, okay? The rules pertaining to capital loss carry forwards. Let me just ask, Abed, what are the rules? Can you just articulate them when it comes to capital losses? If you can't use them in a particular year, what do you do with them? Carry forward gain, is that always true?
No.
And if no, why not?
I don't have the authority. Is that 1212?
Okay, and Elizabeth, how would you articulate Code Section 1212?
And then you can carry it back.
You can?
You can carry the losses back.
You can't? You sure, Nate?
You can.
You can. What's your authority?
Corporate tax. I'm sorry, I don't have the authority.
Nate?
You can carry back. That's 1212, A.
It says what?
You can carry over carry forward 5 years. And I think you can carry back 3.
Mike, you were going to say?
So for a corporation, you have to first try to carry it back for 3 years. However, if it generates net operating losses and you can't take them.
Hold on. Let's just take the capital losses. Capital loss rules are articulated in Code Section 1212 for corporate taxpayers. Corporate taxpayers can carry back 3 years, carry forward 5, right?
Yes.
For individual taxpayers, Trevor, you had your hand up?
I was just gonna say you carry it back, and the authority.
Is that true for individual taxpayers?
Carry it back.
Yeah. Don't look too hard, you won't find it.
No.
No, you can only carry forward, and you can carry forward indefinitely until what time, Mike?
Until you can either, the $3,000 ordinary are taken each year, or you have enough capital gained to net against.
Or can you keep carrying them forward forever?
Expires.
They expire? When do they expire? When you expire.
Yeah, okay, yeah.
You die, your capital losses, add that to the list of many things you can't take with you. Okay? Capital losses, poof, disappear when someone dies. Right? Now just don't get confused that net operating losses are something else. Those are found in Code Section 172. That deals with not capital losses, but losses pertaining to operations. And losses pertaining to operations in yesteryear, prior to this year, could carry back 2 years, carry forward 20 years. Now, net operating losses cannot be carried back, right, Mike? They can only be carried forward.
Yeah, I thought when you were rolling back even capital losses, you couldn't take benefit, generally it created a loss. You could only take them if you had a gain. Like you couldn't make a loss bigger. You couldn't.
You can't make it bigger, but you can use it if your corporation carry it back.
Yes, but I thought you could only carry it back
If you had capital gains.
Right, if you had capital gains. If you didn't have
That's
capital gains, you can't.
Yep, I agree. Now, let me just ask. What is the tax rate applicable to corporations? Okay. Ken Kit. What is the tax rate applicable to corporations?
40%.
Say it loudly.
40%.
What's your authority?
Not so sure.
Mo, you were going to say? Andy? What rate applies to corporate taxpayers? Tax rate applicable to corporate taxpayers? Nick, you were going to say? Yep. 21%. 21%. What's your authority?
Section 1.
Nope. Matt?
Isn't it the Tax Cuts and Jobs Act?
It's true, but that's not my authority. You need a code section. What's that?
I don't know what the code section for corporate.
Roland, you know?
Yes, sir.
Go ahead, Dave.
21B.
What code section, guys? You looked it up in the index. Does it have it under corporate tax?
Is it 11?
What's section 11? What's section 11? And Dane, the corporations have, we know that individuals, right, have a special tax rate, right, under code section 1A, right? Everybody agree? When it comes to capital gains, agree? With respect to corporations, the corporations have a preferential rate for capital gains. What do you think? Yes or no? Yes? Anna, agree? Miles? Agree. The corporations have a better rate than 21% for capital gains. Mike?
No.
No. No. There is only one tax rate. Corporations do not get a preferential tax rate for capital gains. Everyone get that? There is no preferential rate for capital gains. So John, Amanda, Jen, do corporations care? Do corporations care if they have capital gains or ordinary income, or they're indifferent, Amanda?
Indifferent.
Indifferent. Jen?
I don't know.
John?
So they care?
They do care.
Yes.
They do? Ben, you agree? They care if they don't care.
Yeah.
Why?
Could be connected to your business or trade possibly, so it could be treated differently than maybe just as like a separate.
Just feels good.
Yeah.
John, you agree?
I mean, I really don't know.
To Val, Carl, and then I'll come to you, Mike. Let me just ask to Val.
I don't think they would care.
They don't think they'll care. Perla, they care or not care?
I don't think so.
They don't care. Mike?
So they care, but not because of the rate difference, because if you generate capital losses as or you can only net them against capital gains.
Ah, they care. They want capital gains because corporations, by having capital gains, unleash the availability of capital losses. So even though the rate's the same, right, Joe, you were gonna say that?
No, I was gonna say it's transfer pricing, but.
Ah, you could lie to me. All right? They do care. Okay? They do care. Corporations do care. Very much.
Could you explain why they care?
Because in the if they only have one in their income, they can never use their capital losses, right? Because of Code Section 1211. By having capital gains, they unleash the availability of their capital losses. All right, so again, corporations do care about the character of income they earn. Now, the authors talk about the carry forwards, and if you have long-term and short-term capital losses. Picture, if you will, of a taxpayer with long-term and short-term capital losses in the current year. Which do you use in the current year, and which do you carry forward? So picture, if you will, a taxpayer has both short-term capital losses and long-term capital losses. Which do you use in the current year? Zahara? And you carry forward your long term? That is correct. Okay? That you will use your short term capital losses first, and then to the extent of your long term, you'll use them, but if need be, you'll carry them forward. All right? And we'll see, this is not me making this up, I can't. You'll see that bias of utilizing the short term first before the long term is cryptically, as the authors express it, found in Code Section 1212B2. I'll repeat. Code Section 1212B2. Cryptically, as utilization of the short term. And we'll see this in the problems if you look on page 701. If you look at year one on problem 7, page 701, there's taxable income of $10,000, long-term capital gains of $2,000, long-term capital losses of $6,000, short-term capital gains of $2,600, short-term capital losses of $1,000. So if you take year one, what's your long-term capital loss? How much, guys? It's not hard math, right? How much? 4,000. And there's a short-term, right, capital gain, right? $1,600. Can you net the two? Yes. Code Section 1222. What does that give you? Long-term capital loss, right? 2,400, right? Can you use that entire loss? Yes, you can use the whole loss. Agreed? The next year, we have long-term or short-term capital gain or loss, guys. Not a trick question.
Long-term capital gain,
Long-term capital gain,
8,000.
how much?
8,000.
Is it a long-term capital loss of 8,000, Angie? Didn't they have a 10,000 capital loss, 10? Capital gain of 2? 8,000 long-term capital loss. Everyone agree?
Yeah.
8,000 long-term capital loss. And do they have a short-term capital gain or loss?
Loss.
Loss. Short-term capital loss. How much?
2,000.
So the total here is the 10,000, right? Capital loss. Everyone agree? Now, the question. We know how much in advance we can use, right? At the 10,000 capital loss, right? Everyone's holding up 3 fingers, right? I'll pretend for a moment, right? Everyone agree? That's section 1211. Agreed? You can use up. This is an individual taxpayer. You can use up to 3,000 of the loss. Agreed? Now the question is, du jour, long-term or short-term capital loss. What do we use this year? What do we carry forward for next? Right? That's the question. So Mike, you were going to chime in?
We would use the 2,000 short-term capital loss plus 1,000 of the long-term capital loss.
And now, the way to get there, Mike's correct. And you would use 2,000 of the short term and 1,000 of the long term and carry forward, right? 7,000 of the long term capital loss for next year. But the way you get there, just so you know, the code creates, and this is not unusual, just for purposes of computing the carry forward, just in a worksheet. Okay, it's in the code under code section 1212B2. It says create a short-term capital gain of $3,000. This is in 1212B2. Short-term capital gain of $3,000, which would give you a $1,000 overall in year 2, give you a $1,000 short-term capital gain, and that would leave you, right, when you netted these out, 7,000 of long-term capital loss. But this 3,000 is purely artificial. It's just there to create a mechanism for computational purposes of what the carry forward would be. Okay, so it's not a real number. The code says, well, you want to compute what the carry forward would be. We're going to go through this exercise of creating an artificial short-term capital gain, and this will help guide you what would be the carry forward. All right? So I'm just sharing that with you. All right, any questions on that? Let's turn our attention to the next segment of the chapter, which is capital assets and definitions. What is a capital asset? And where would you look? Right? So Angel, where would you look? David? 1221. And David, is that definition narrow or broad? Say again, say it loudly.
Broad.
Broad, right? It sort of starts off just like Code Section 61, that any accretion to wealth is taxable. Code Section 1221 starts off broadly saying all assets in this world are capital assets, right? Every single asset. When you look around you, go home tonight. Look around you. Are you looking primarily, EK, in capital assets or non-capital assets? When you look around your house tonight, EK. Ryan, you agree? When you look around your room tonight, you're looking at capital assets or non-capital assets? What do you think?
According to that,
What?
according to this, it says everything is, but there is exceptions.
All right, so your exercise tonight, guys, go home, put in a long day on Monday, right? Look around your room just as a final mental exercise for tonight. And when you look around the room, you'll see it's just filled with capital assets, right? Kind of neat. But there are exceptions. Miles, can you tell us one exception?
They're in section 117.
What was that?
Are they in section 117?
117? I don't think that would be where you would find exception. Dan?
Primarily held for sale in ordinary course of business.
And another word for that is?
Personal inventory.
Inventory, right? Everyone agree? Yes. You go to Home Depot or ShopRite or Whole Foods and they sell you products. Are they going to have capital gains or ordinary income?
Ordinary.
Ordinary income. Everyone agree? That's the quintessential non-capital asset is inventory. That's one exception. There's two other major ones. There's a lot of exceptions, but two that often come up in practice. What are the two that I'm referring to? Go ahead, Matt.
Patents, inventions, intellectual property along those lines.
Yeah, those come up. Those don't come up. Just if you don't mind me saying, Matt, patents aren't something that comes up regularly in your practice, probably, that you're going to be buying and selling. But if you look at 1221(2), property used in a trade or business of a character which is subject to allowance for depreciation or real property used in a trade or business, that's a lot. In other words, people buy and sell machinery used in their business, right? Like a cash register. And those are not capital assets, okay? Everyone agree?
Yeah.
Assets used in a trade or business are not capital assets. And I will take liberty, and I will tell you, you want to make your book more valuable, your code book, for its next user, you may want to write in Code Section 1231. These are 1231 assets, okay? And we're going to learn, believe it or not, 1231 assets actually may be better than a capital asset. How do you like that? Okay, so 1230, my point is, assets used in a trade or business, Jen, are 1231 assets. Okay, but they are not capital assets.
Those be all fixed assets?
Say again, Matt?
Will be fixed assets on the company's balance sheet?
Yeah, a lot of fixed assets, absolutely. Those are 1231 assets, they are not capital assets. Finally, another big one that comes up often in practice, accounts receivable. Michael?
No.
Okay, so yes, there's other exceptions, but the big three, inventory, assets used in a trade or business, and accounts receivable are non-capital assets.
receivable and non-capital asset, but it's ordinary income.
I mean,
So,
it's right here in the code. I don't know what you mean. How is it not? The code defines it to be a non-capital asset. So if you have $100,000 account receivable on your books, and you sell it for $100,000 or some discounted rate, that's what will give rise to ordinary income.
ordinary income.
So bear that in mind. Bear in mind that the code, aside from what I just told you, is some of you pointed out there are other exceptions. It's not just these big three. I mean, patents, inventions, and the like are not considered capital assets. Certain commodities. Look, you can read it for yourself. Look at these exceptions. All right. But again, when you go home tonight, last I checked, when you look around your room, you don't see too much inventory, right? You're not selling, unless you're a 420 seller when you look around your house. Or you're not going to have a cash register, right? You're selling. So when you look around, there's no accounts receivable in your bedroom, right, guys? You've got a pretty funky bedroom if you do. My point is, you're surrounded by capital assets in general. Agreed?
Yeah.
Agreed. So the authors want to give us a glimpse, a better glimpse, what's a capital asset. So they're going to walk us through various assets, and they're going to do it by way of introducing cases. So there's a modeling case on page 701. And I can ask, in this case, Nick C. Did you have a chance to read it?
I did.
And Andrew, you can chime in if.
Oh, yeah. So he bought a plot of land in New Mexico.
Okay.
He came into hard times and has switched what he was doing with the land multiple times.
All right. So what was he originally? Before he bought the land, what was his trade? Andrew?
He wanted to use the property for cattle.
Yeah, but what was his background, training, professional? In Miles?
I was going to say the cattle thing as well.
Wasn't he a lawyer?
He was a veterinarian. Missed that. Didn't get the memo. He was a veterinarian. Sort of probably, might have helped with his cattle grazing, but he bought the land and thought he could probably make some money, right, guys? Yeah. Bought it as an investment. Nick, you were going to say?
Some government, I don't know if it was the federal government or the local government, took some of the land to make changes to it or to put a road through it.
Yeah, I don't know if it took its land or they had an easement, but they did put a road through it because the city started growing. And as a result, the land that once was not valuable, as the city limits expanded, became more valuable, correct?
Correct. And with the wartime, it had like economic value to businesses too.
Right. Andrew, you're going to comment?
Well, yeah, they had, it was a military type of town. I think they had, that's what they referred to in the case. So that's why the population grew tremendously, because the work for that was.
So the land became more valuable. What does our taxpayer do?
Started subdividing the properties.
Started subdividing, right? What does he start doing? Selling the land. And he reports that not only is he a veterinarian, but on his tax return, apparently he dealt in lumber as well. So real estate is not necessarily his trade or business. It's something like you guys are accountants. You might decide, aside from being an accountant, you might on the side, right, invest in land and maybe make more money doing that than in your accounting practice, who knows, but might supplement your income. And he too, aside from lumber, he's buying and selling these, in this case, selling, subdividing, then selling lots. And how does he report the income?
Doesn't? Well, there's, I'm not sure what there's capital.
he reports it as capital, right? He'd like to report it as a capital gain, right? Remember, in chapter 6, there was a computational issue, right? How much? In this chapter, which to me is natural to follow, obviously, I think it's natural, is not a question of how much, but rather what is the character? Because so much turns on that, because depending on how you classify it, the tax rates can be literally almost 1/2 of the normal tax rates, right? So it's pivotal. And the taxpayers in general would prefer capital gains. The taxpayer here reported capital gains, and the question is, did it qualify, right? Nick?
Yeah, the subdivision of the property qualified it as, and that's what the differentiation there, that's what kind of pushed it over, made it investment.
Made it,
Not capital income.
so what did it make it into? Just, again, when you're meeting with clients, you gotta talk the talk and walk the walk. Made it into ordinary because why? What kind of,
Well, because he was using that as a form of income because it was essentially a business he was running. And
put a name to it, Michael?
Inventory.
Right, there's only one word. Right? By making it into subdivisions, it transforms its character potentially from an investment into inventory, right? And the authors of the opinion on the top of page 705, at the top of page 705, say, why the purpose for which the property was acquired is of some weight. So originally he bought it for investment purposes. The ultimate question is the purpose for which it was held. And it says in the next paragraph, 705, admittedly, Maudlin originally purchased the property for purposes other than for sale in the ordinary course of business. And then life changes, right? Things happen. And it became inventory in his hands, giving rise to ordinary income rather than capital gains. I will call to your attention, and we'll see this a little, I'll give you a little bit more foreshadowing. Take a look at Code Section 1237 if you have a moment. Congress, we know, is a tax code written in, how do we say, a little bit of favoritism towards the real estate industry? Yes. Will that come as any surprise to the people in this room? There's a little bit of a bias, and I say there's tongue-in-cheek towards the real estate industry. So, on page, all right, Code Section 1237, real property subdivided for sale talks about the fact that in limited circumstances, if certain conditions are met, okay, and the person holds property, real property, for 5 or more years, or more than 5 years, I should say, and there's no substantial improvements made on the property, then it can qualify for potentially capital gain. So here is Congress going out of its way to say if you subdivide property in certain instances, that it has a little bit of aroma of being inventory, but if you don't overdo it and you only sell up to 5 properties a year, you can still command capital gain treatment. It is calling this to your attention that Congress always has the right to take a case like Maudlin. And now, in Maudlin, he sold more than 5 properties. Okay, so 1237 probably would not have helped him. But and if he made substantial improvements, 1237 doesn't work. Andrew.
So, current day, real estate companies that, big real estate companies that they sell, let's say, thousands of houses a year.
That's going to be inventory.
Right. Because
1237 has no application. So Hovnanian, right, big real estate company, all ordinary income. Okay?
Let's say it's a mom and pop shop, you only sold 5 houses.
5 houses are different, because this talks about like, if you own 5 pieces, or if you own 1 piece of real estate and you subdivide it, but you haven't made improvements, you're talking about raw land, you subdivide it, and now you sell it to a builder. That probably would qualify for capital gain. Now I'm talking about 5 houses. Okay? Mallet, beginning on page 705.
Can I ask you, 1237, is it very strict with the duration of 5 years? And whether
Yeah,
it's
you've got to hold it for more than 5 years. Sell for a period of 5 years. It's going to be held at least for a period of 5 years.
So if that's the case, then you can qualify for capital gains treatment?
If you meet the other requisites, which we'll talk about later, but just give me a hint that if you subdivide property, you're not necessarily inventory. You might qualify for this exception. The code is, you got to be careful. Just so you have a client who subdivides the land. I know several people in Harding who will take a piece of property, they own 5 acres, and they'll subdivide it to make some extra money. And they'll sell off 2 of the 5 acres. And you can't just say to them, oh, you have ordinary income. Because if you're in Harding and you sell off 2 acres vis-a-vis a subdivision, probably can get away with using code section 1237. Mallet. What is the thrust of this case? Recall Matt G. And get there, Angel. Angel, do you have a chance to read this? Just make sure you guys keep up to speed, because Chappelle, did you get there? Because if you don't, the exam is not going to be good for you or me. Ron, you get a chance to read this? David? Dan? Yeah, what happened?
Petitioner bought property for an apartment project.
Right.
And then I guess some complications caused the petitioner to sell plots of land.
Right.
And he picked up that gain as ordinary income. Then I guess the pieces that he had remaining, there were some zoning issues on the remainder of the land. And then he sold the remainder of the land and picked it up as long-term capital gain. And the district court found that the property held for sale. It was sold in ordinary course of business under 1221A1.
All right, so there's a real question here. Under code section 1221, whether or not the property here was inventory. And the case turned on what the word primarily meant, right? Because when the taxpayer bought this, they were possibly holding it for sale to customers or possibly holding it as an investment. And to be inventory, it has to be primarily, emphasis on the adverb primarily, held for sale to customers, right? So the Supreme Court, this case is in the Supreme Court, and it's looking to investigate what does the word primarily mean, right? To see if the standard was met. Because if it's not met, it will give rise to capital gains. If it was met, then it will give rise to ordinary income. All right, so I'm sorry, go ahead, Dan. What's the court decide?
The Supreme Court found that primarily means of first importance and vacates the district court decision.
So the word primarily, they go to the dictionary and they say, gee, when they look up the word primarily means of first importance, right? Principally. So it says this is the standard the lower court should apply, so they remand it to the lower courts and say, apply this standard. And what was going on with the taxpayer? Was this the primary reason they were holding the property? And if you looked at the footnote on remand, the district court ruled that, was it primarily?
It was not.
It was not primarily for sale to customers, and therefore, if it's not primarily sale to customers, then what does it qualify as?
long-term capital gain.
And it qualifies as long-term capital gain. Dan?
Just a quick question, right? Okay, so that piece that they paid, that they picked up as ordinary income originally, and they go back and claim a refund for the difference?
They don't know enough about the original, whether or not that piece was really held for sale to customers.
So they'll look at them individually.
Yeah, I think you gotta look at each one individually. All right, now, does everyone think they can properly identify what is a capital asset and non-capital asset? Everyone, like, you know, the old saying that if you met a Martian, you could you could help the Martian identify what is a capital asset, non-capital asset. So everyone's feeling comfortable, right? So let's see how comfortable you are. If I could give you or share with you a little story. First of all, let me, by sharing my story, ask you, do most of you know where St. Barnabas Hospital is?
Yes.
It is where?
Livingston.
It's in Livingston, right? And if you don't know where St. Barnabas Hospital is, if you ever got into a serious accident and you were burned, you were taking a helicopter ride to St. Barnabas. St. Barnabas probably has the biggest burn center in New Jersey. Is that a fair statement if you've ever heard about St. Barnabas Hospital? They've got a whole board and the whole shebang there. Anyway, that's not the issue du jour. About 15 years ago, I'm reading the New York Times, and on the front page, they're talking about St. Barnabas Hospital, and they're talking about the fact that at St. Barnabas, that the infertility clinic there, that women are getting how much for their eggs? $5,000. And it's talking about the ethics, the article about women being paid for their eggs, this sum of $5,000. Now, the average reader is curious about the ethics, but I'm curious about, how do women reporting the receipt of the $5,000, right? So, how do you think the women are reporting, Jen? What do you think? How are the women reporting this? Amanda, Ron, how are the women reporting the receipt of this $5,000? Amanda, you were going to say?
I have no idea.
Well,
I guess it's a capital gain.
And what would you say, Jen? And Ben? Well, forgetting about how they might or should, how do you think St. Barnabas is reporting this to the women who are participating in the program? If you're St. Barnabas Hospital, how are you reporting this?
They're expensing it.
Say again?
Are they expensing it?
Why would St. Barnabas expense it? In other words, I'm asking how they're reporting it for the women who are getting paid the $5,000. But remember, I'm asking how St. Barnabas, what kind of information return they would issue. Let me just ask Miles.
Are they using it for R&D, so they can expense it that way?
Well, it's not R&D for them, right? Michael?
Are they giving them a 1099?
They are for what?
Oh, for the money they paid.
And what kind of 1099?
1099C.
What is 1099C?
That's if you're self-employed.
They're actually giving them a 1099 miscellaneous. Why? Now, let's put it this way. I've never given eggs. I can't give eggs out. But rumor has it, it is not easy to give eggs. Like, you have to be juiced up on a drug called Clomid. And it's not that easy to extract eggs. It's a whole process. And it doesn't take 5 minutes. It's a labor-intensive activity. And it sound right that, politically speaking, that if you paid, I happened to hook the head of the infertility clinic at the time. I knew quite well. So when I saw the article, I could call. I'll leave names out. I could call him up and say, "Hey, how are you reporting this?" So very casually told me they're reporting as 1099 miscellaneous because politically, they don't want to be looking like they're in the business of buying and selling babies, right? That doesn't sound right. Everyone agree? But if you're paying a woman for her services, right? Makes sense, right? $5,000. This takes anywhere from 10 to 15 hours. Involves drugs. So it makes sense, right? Everyone agree? They're being paid, and we know how is income from labor taxed? Ordinary income, what's her authority? What code section? 61, okay? Is it game over? Well, that article came out in the Times, and literally maybe a month or two later, there were ads starting to be placed suggesting that people were willing to pay not $5,000, but $50,000 for Ivy League women to donate their eggs. In other words, people were upping the game, right? If they could find the right person. And it's kind of interesting. Different cultures, depending on what culture you're from, some are more inclined and some are less inclined culturally to donate eggs. So interesting about the psychology of this. But putting that issue aside, once you start paying someone $50,000, it does have a much stronger aroma, right? Of being payment for the eggs and not simply for the services. Everyone agree? $5,000 you can say services. $50,000, right? Starts looking more like reality check, payment for eggs. Okay, you guys have studied Code Section 1221. You're counsel for one of the women who sold her eggs for $50,000. How are you going to tell her to report that? And why? You can't just, Andrew, how would you're representing a woman who just sold her eggs. What are you going to tell her?
Maybe I shouldn't say, I don't know, I mean, capital gains.
And if you say capital gains, why?
Inventory.
Well, if you say it's inventory, but Andrew, haven't you just subverted your own argument?
I'm sorry?
Haven't you just subverted your own argument? I mean, I'm trying to say you're an advocate. You wouldn't, so what would you say and why would you say it?
Oh, right, sorry, yeah, I misspoke.
So how would you tell your client to report it, Andrew?
Capital asset.
Why? You got to be able to articulate, not just because you said so, right? So, Angie.
Yes.
You're a good person to respond to.
So I was thinking because they're not in the business of selling eggs, and then they're not, it's not that they are going to repeat or they are repeating this throughout.
So how would you report this if you sold your eggs?
The capital gain.
You would report it as a capital
Not as
gain.
an ordinary income because the eggs would not be held as inventory.
All right, so Angie says this is distinguishable from inventory, right?
Yes.
And she said, as such, she reported as capital gain. Agreed?
Yes.
Now, I was talking, and if you ever get tired at night and you want good reading material to fall asleep to, I wrote a piece. This really intrigued me about how this should be reported. And when I wrote the piece during that summer, many summers ago, I sort of canvassed women, and said, would you like to be a test, have you sold your eggs? If you have, would you want to be a test case? And there was one woman who said, oh yeah, I did sell my eggs. And she was an aspiring actress. And the problem, Angie, was she had sold her eggs on 5 different occasions. And truth, if you talk to any infertility clinic, Clomid is not a health drug, okay? You're not supposed to take Clomid on a regular basis. But if you go from one infertility clinic to the next, there's no communication between them. You can do what you want with your body, and you can sell your eggs, because when you're making $5,000 a shot, or maybe $50,000, you can make some really good money. There's risk involved, And once you told me she's selling her eggs 5 times, she's not a great test case, right? Because then it does, right? Angie, notwithstanding, starts looking like inventory, right? Like you're in the business of selling your eggs. So she dropped out of being my test case. I mean, there is a distinction, right? How can you say your eggs are different from inventory for the women in the world? What distinguishes your eggs from a chicken's eggs? Ben, you were going to say?
I was gonna say like just constantly readily available, like inventory for supermarket, you can grab it off the shelf. I don't know if it's always going to be there.
Well, by saying, you were going to say, Tofu?
They're not usually available for sale.
Well, you can make them available for sale.
They usually.
In a hen's eggs, you know, they're not readily, you gotta, you know, pick them up and bring them to market. I mean, but the one important, I think, distinction is chickens can lay as many eggs as they can over their lifespan, where women are born, right, with X number of eggs and they never produce more, right? So it doesn't have this notion of replenishment that a chicken's eggs do have. So that's, I think, a really distinguishing factor from inventory, right? There's this no notion of replenishment. Let it be said, if you want to check out 2 years ago, I was thrilled. There was a case of a woman selling her eggs. It's called Perez, P-E-R-E-Z. You can pick it online, Perez v. Commissioner. But here's the killer about the case. This woman sold her eggs, and she had an attorney represent her. What was her claim? She claimed that she didn't have income at all. Okay, she claimed literally that this was like an extension of her body, and that like this could not be considered, the money she received was not taxable income. Now, to me, and here's a shocker for you in the room, did she win or lose on that argument? Lost. Okay. As an attorney, and I don't know who argued her case, there should have been a plan B. Like, if I lose and it is taxable, I should get capital gain treatment. But that leg of the argument was never put out there. In other words, her advocate argued only one leg of the piece and never argued a plan B, at least to save taxes or get that issue clarified. So, let me repeat to this class as I repeat to all. If you or a friend have ever sold your eggs, report it on Schedule D, take it as a capital gain, and let's see where the chips fall. And I will be okay? So that issue remains outstanding. But if you want to get a flavor, go look at this Paris case. It is one case on the issue, but it does not resolve the issue. All right, any questions on that? Andrew?
So I'm asking just out of pure curiosity at this point. I mean, so the person that you had spoken to, right? You said that she was, she basically went 5 times, so she was basically using her eggs as inventory.
Yeah.
Hypothetically, whatever.
The ideal case, the woman would have sold her eggs once. She would have been a great case.
Okay, so what's the difference if you sell it once or if you sell it twice or 3 times? Is there a numerical time?
I think everyone in this room would agree that there's a visceral feel difference if you sell it once versus selling it multiple times. There is no, this is uncharted territory, Andrew.
Right. No, I agree. I think it's something to talk about, but is it maybe the sense that it's a finite amount of eggs, or?
I mean, again, we could talk all night, it won't get us very far. I mean, these make for interesting discussions. My point is, Code Section 1221, and a larger question, again, is it worthwhile having in the code a rate difference? Okay, getting back to one of the questions I posed much earlier. Does it make sense to have such a big rate difference? And when and if you read this new op-ed I'm working on about asking Alexa, you may want to ask Alexa how her eggs might be taxed, but I don't know if you'll get a clear answer for her. But part of the argument I make is that I'm not convinced that there should be a great difference. All right, let's just talk about some of the other material that we're going to be confronting in chapter 21. So what the authors are going to do is the authors have defined or helped us define what is a capital asset. And beginning on page 709, keep in mind, when you look at code section 1222, 3 conditions have to be met to get to the promised land. I said it before, I'm sorry for my repetition, but it can't hurt. Code section 1222 requires a capital asset, requires a sale or exchange, and requires being held for more than 1 year. Right? Got to meet those 3 conditions. So we got to know what is a sale or exchange, right? And that's what the authors are going to articulate beginning on page 709. Page 717 begins a discussion of what is the holding period. What is the holding period of an asset? So now that we know what a capital asset is, the sale or exchange, and the holding period, those 3 conditions. Beginning on page 723, courts have looked at this statute and they added their own gloss to what is the meaning of a capital asset. Okay, so we're going to look at what various courts have said are capital assets. But remember, Congress always has the last word here, right? If it doesn't like a particular outcome, these are not constitutional issues, right? These are political decisions. So beginning on page 745, we're going to see that Congress is going to statutorily provide for winners and losers here. And we'll articulate who's going to win and who's going to lose. And finally, towards the end of this chapter, we're going to spend a great deal of time, be forewarned, but it's worthwhile, looking at code section 1231. Because 1231 are, again, assets that are not capital assets, but can, hear me, because people get confused by this, even though they are not capital assets, we look at 1231A, they can give rise to capital gains if the gains exceed the losses. If 1231 gains exceed the losses, the product is capital gains. Conversely, for your notes, if the losses exceed the gains, you get ordinary loss treatment.
If the losses exceed the gains.
If the losses exceed the gains. So what we'll see, because of the capital loss limitation rules, that these rules, right, are actually better than capital asset, because what could be better? You get capital gains and preferential rates if the gains exceed the losses, but if the losses exceed the gains, guess what? You get ordinary losses, and what that means is you avoid the limitations under code section 1211, right, EK? And if you avoid the 1211 limitations, that's a good thing. So if you could, and guys, again, time will get short here. We have 2 more classes before the midterm exam, okay? 2 more classes. And we do have class Columbus Day, okay? Don't not come on Columbus Day. We'll celebrate together Columbus Day. But we have class Columbus Day. So I will see everyone here next Monday, but please stay on top of your reading for next week, okay?